All right, welcome. Today we are going to do a full masterclass on mutual funds. The goal here is simple: to cut through all the noise and give you a clear guide that you can actually use. So let's just jump right in. Look, if you've ever stared at the mountain of investment options out there and felt completely lost, trust me, you are not the only one. It can feel so complex. But don't you worry, we've built this whole explainer to be your simple, clear starting point. So here's the game plan. First, we're going to cover why you should even care about funds. Then we'll get you up to speed on the key terms, your toolbox, if you will. We'll dive into the big active versus passive debate, show you how to actually pick a good fund, and then finally, how to put it all together. Sound good? Let's do it. Okay, let's start with the most basic question of all. With all the options out there, why bother with a mutual fund in the first place? And it's a totally fair question, right? I mean, you can go out and buy shares of Apple or Amazon yourself. So what's the point of a mutual fund? What problem is it actually solving for you? Well, here's the deal. Picking individual stocks that are going to be winners is hard. It takes a ton of time, a ton of research, and honestly, a lot of expertise. For most of us, mutual funds are just a better tool because they let you outsource all that heavy lifting to a team of pros. And why is it worth the effort? Well, because of this number. Historically, the stock market has returned, on average, somewhere in that 10 to 12% range annually. Now, compare that to maybe 4 or 5% you'd get from something super safe, like a CD. You can really start to see the power of long-term investing. You know, the great thing about funds is just how flexible they are. You can get started with a really small amount of money. You don't have to become a financial analyst overnight. And hey, if life happens and you need to pause your investing for a month, there's no penalty. They're just a fantastic tool for building wealth over the long haul, especially for goals that are 5 or more years down the road. All right, section 2. Let's build out our toolbox a bit. We're going to quickly run through some of the essential jargon you'll hear so you know exactly what people are talking about. Okay, first up, a no-load fund. It's exactly what it sounds like. There is no load, which means no sales commission. You're not paying a broker a fee to sell it to you. So if you're a do-it-yourself investor, someone who's comfortable picking their own funds, this is what you're looking for. Why? Because it means more of your money goes to work for you from day one. And on the other side of the coin, you have a load fund. This one does have that sales commission baked in. Now, that doesn't automatically make it bad. If you're working with a financial advisor who's giving you great advice, helping you plan, maybe even talking you off the ledge during a market crash, well, that load is how they get paid for their expertise. You just have to know what you're paying for. Now, this one is huge. The expense ratio. Think of this as the fund's price tag. It's a small percentage that gets taken out of your investment every single year to cover the fund's operating costs. It might look tiny, like maybe 1%, but trust me, over 20 or 30 years, a high expense ratio is like a slow leak that can sink your returns. So the golden rule here is simple: lower is always better. Okay, let's get into the main event. This is maybe the biggest debate in the entire investing world, and it really comes down to a simple choice. Do you want your fund to try and beat the market or just be the market? So on one side, you have active funds. These are run by a star manager and their team who are actively trying to pick the best stocks to get better returns than everyone else. For that effort, you pay a higher fee. On the other side, you have passive funds. They don't try to be clever, they just buy all the stocks in a market index like the S&P 500 to match its performance. And because a computer can do that, the fees are incredibly low. So you're probably thinking, well, why would anyone settle for just matching the market? Here's why. The data, year after year, shows that most of those highly paid active fund managers, well, they failed to beat their simple, low-cost index fund competitors over the long run. It's just really hard to beat the market consistently. And you'll hear the term ETF a lot when people talk about passive investing. It just stands for exchange-traded fund. The easiest way to think about it is this. It's an index fund that you can buy and sell all day long on the stock exchange, just like you would a share of any company. Super convenient. Okay, so we know what funds are and why they exist. But now for the big question. With literally thousands of them out there, how in the world do you pick a good one? Let's get practical. I'm going to give you a simple 4-point checklist you can use for any fund. Number 1, we already talked about it. Check that expense ratio. Is it cheap? Number 2, who's the fund manager? That amazing 10-year track record doesn't mean anything if the person who achieved it left last year. Number 3, Look at rolling returns. You want consistent performance, not a fund that was a one-hit wonder 5 years ago. And 4, check the turnover rate. A low number suggests the manager is a confident buy and hold investor, not just frantically trading. And you'll see funds grouped into categories like this. It's pretty straightforward. Large cap means they're investing in the biggest, most stable companies. Mid and small cap funds are hunting for smaller companies that have more room to grow. And a flex cap fund just means the manager has the freedom to invest wherever they see an opportunity, big or small. All right, we're in the home stretch. We've got all the building blocks. Now let's talk about putting them together to build your first portfolio. And I'm going to tell you right now, the most important word here is simplicity. I had to share this quote from an advisor. He said the craziest portfolio he'd ever seen had, get this, 113 different mutual funds. 113! People think more is better, but that's not diversification. That's just chaos. So if 113 is nuts, what's the right number? You're gonna love how simple this is. The truth is, for almost everybody, a really well-built, diversified portfolio needs maybe 4 or 5 funds, at most. That's it. So what could that look like? Now, major disclaimer, this is just an example to show you a structure. This is not personal financial advice. But you could have a solid large cap index fund as your core. You could add an active flex cap fund to act as your growth engine, and then maybe something like a gold fund as a diversifier, since gold often zigs when the stock market zags. And that is pretty much the whole shebang. We've gone from that initial feeling of being overwhelmed all the way to understanding the key terms, the core strategies, and how you can build a simple, powerful portfolio. You now have the foundation to do this with real confidence. So, I'm going to leave you with a question. Now that you have this knowledge, what is the first actual concrete step you are going to take for your portfolio? Don't just let this be information. Turn it into action.